Good afternoon and welcome everybody. Good afternoon here in Toronto, that is. It's Joe Pochadiniak with McNichol and Associates Asset Management, and I'm really excited to bring in two of our really trusted real estate partners in the 360 fund from Connor Investment Real Estate. We're going to be hearing from Philip Guyton and Paul Connor. And, Philip and Paul's company has really helped us make sort of a quantum leap in land investments. We're no longer, buying parcels of land and hoping for the best. They say hope isn't a strategy, and I've had the pleasure of working with Paul and Philip over the years. And really just sort of getting a better grasp of exactly what they're doing. And exactly what they're doing is great. I think it really speaks to a lot of the values and investment philosophy we have here at McNichol. It's focused on facts and data, and they make inferences from there, not the other way around. They're very well trained. A lot of their reporting and communication strategy to myself especially is very effective. And I just want to thank Paul and Philip for really providing myself personally with some coaching as to how land banking is done in their particular state, which is going to focus on the state of Texas, and how it's different and unique. So, Paul and Philip, welcome. I'm just going to ask you guys to introduce yourselves, and maybe a lot of our investors may have familiarity with your firm, but for those that don't, maybe they're not familiar with Connor or land investment. Maybe just go ahead and introduce yourselves, and I'll put myself on mute here for a bit.
Sure. Appreciate the opportunity. Paul Connor, founder and principal of Connor Investment Real Estate. We focus on capital and investments within primarily residential and industrial opportunities. Home base is Houston, and we focus primarily on Texas is the main target for the majority of our investments and projects, but we do have the ability to operate in other states, specifically within the southeast side of the United States, kind of ranging from the Carolinas to Florida, and back across the Gulf over to Texas, where we see continued long-term macro trends of job growth, population growth, which support a lot of the tailwinds and thesis we look at when we look at new projects and investments. Philip?
Philip Guyton. I've been here in Houston most of my life. I have a background in engineering, and I've been in the real estate sector for I think 25 years now. Joined with Paul Connor over 5 years ago, though we've known each other for many years. And we work together very effectively on this strategy, land banking primarily. And the nice characteristic of it is that capital preservation is a big part of the strategy. And to date, we've had a terrific track record. And enjoyed working with McNichol and Associates over the years. They've been an excellent investor of ours.
Okay, great. So maybe at this point, if you gentlemen would like to get into your presentation a bit, we can go from there. And yeah, I'll just mention again for some of our investors who might not be diehard land investors, it can actually be a pretty risky part of commercial real estate. Land doesn't really pay you any rent. You have to wait around a bit to get a buyer. So I appreciate the comments about risk management, capital preservation. Those are all things that we really like around here. But back to yourselves. We can go through some slides here for sure.
Sure.
Okay.
So today we'll talk a little bit about the Texas and U.S. market, what we're seeing as far as macro trends and why we invest in the fashion that we do. Secondly, I'll touch base on kind of the three or four core styles of investment that we typically put together when we do new investment partnerships. One being land banking, which has always been our bread and butter. Two being direct equity investments in master plan community or suburban style development. And then three, the direct investment into what we'll call heavy industrial manufacturing activity and logistics parks, which we see as a long-term trend that's occurring, especially along the Gulf Coast within the United States. And so that's an area where we will continue to grow as well on that. Figure the easiest way to do it is show everybody a little bit about what we do and touch base on a couple of our previous projects, how we were involved and what it did from there. First project we did, which is Sunterra, large scale project, so about 2,300 acres on the west side of Houston. Within that project, we did that with Land Tejas and put it together really kind of 2 or 3 ways. One, we were a land banker on several hundred acres within that has now been developed. 2, we were part of the direct equity on developing that project. And then 3, we've looked at lot banking, which we do variations of for certain private home builders, where we serve as an off-balance sheet source of capital for private home builders to allow them to hold their inventory off balance sheet and work closer to a just-in-time style of inventory management for home building. That project is currently one of the top-selling communities in the city of Houston and likely in the entire state. I think it's actually top 20 in the U.S. This project, along with several others, was actually bought out by Starwood Capital. Their home base is in Florida, but they bought this and the remainder of the Land Tejas portfolio that was the developer along with us about 2-3 years ago at this point. And so they have continued to thrive on this project. So at total build out, this 2,300 acres will actually be around 7,000 to 8,000 homes by the time they finish the overall development of it. So been an enormously successful project. One of our favorite ones to put together because we were able to be very value add to the developer on bringing the capital into strategic points where, 1, they made it very effective for the developer, and 2, made for a very compelling investment opportunity with our partners on this project. Next project that I wanted to highlight is what we call River Ranch. This is a current project that we have up and going. So it is about 2,500 acres. Will be about 7,000 watts, 6,000 to 7,000 watts when we get to total build out on the overall project. This one is actually currently in development. We are both a land banker on the front portion of the property, the commercial piece, as well as a direct equity investor in that project. And in that particular one, we're what we'll call the preferred equity. So we are the first distributions once this project becomes profitable. We will be the priority of distributions on this project. Continues to perform well. We actually just sold approximately 750 lots to 11 different home builders during the last 60 days. And so that project is quickly taking off. We believe that this project will be in the top 3 in the city of Houston by end of next year as the different home builders ramp up operations latter part of 2024 and into 2025.
That's great, Paul. And just for our viewers, this is one that, if I recall correctly, our investors are a part of. So that's great. But you're talking top 3. Yeah, no, it's excellent.
Absolutely. No, it's in a fantastic position on it. The principles behind the developer, the development entity, several were formerly Land Tejas connections that we had. And in putting this project together, we pre-contracted for nearly 1,000 lots that would be pre-contracted and it'll eventually be sold to the home builders. And that's one of the ways that we help mitigate perceived risk on these projects, is that we work diligently at the very beginning, before we even invest on it, to ensure that there is a viable and determined exit on the property. And that's
as you know, and in terms of my discussions in the diligence process for our investors, as you know, and Philip knows this as well, that's one aspect of your operations that I love. And that's one sort of major way in which our investors get the benefits of land investing without, a lot of unfortunately, the risks and drawbacks that can come with it.
Absolutely. When it comes to true development deals, such as River Ranch, having it pre-contracted to proven home builders with hard earnest money contracts in place that basically secures their position, it's a way for us to ensure a timely exit on the lot deliveries as those get developed out. And similarly, whenever we do land banks, where we're purchasing dirt, and in that case, it's just raw land, but we put it together in a way to where we have surety of or performance in place for not only getting the entitlements and the engineering, but for the actual repurchase and then eventual development by the developer. So when we put these projects together and these investments, one of the key metrics or key goals is have that exit already tied up and predetermined even before we get into the project on it. And so that helps us ensure successful delivery on the different investment partnerships that we put together. Next project I want to put in front of everybody is the Gulf Inland Logistics Park. And this gets back into what we'll call the heavy industrial logistics park manufacturing, which is we consider one of the long-term trends that's going to be increasing over the next 10 to 15 years as we see companies continue to reshore or move their manufacturing activities back to the United States, whether they're relocating from China or from Eastern Europe or in Western Europe on some of the relocating groups. We see a magnificent amount of interest from large-scale manufacturing, from automotive manufacturers, battery manufacturers, EV production, chemical blend groups, steel recycling groups. And so there is a tremendous amount of opportunity coming back to the United States where we're seeing groups come and locate their manufacturing opportunities here. Gulf Inland Logistics Park, we closed on it just over 2 years ago, or right out 2 years ago. Currently have 4 new users in there. We'll close it to 3 more users that'll have manufacturing activity. And in this particular instance, we have access to both rail and major highway infrastructure, so it can operate almost like an intermodal location, as well as being in relative proximity to the Port of Houston. So we have a lot of interest from groups that need to bring in raw supplies by rail or by sea transportation. They can bring it to this site, do the manufacturing, and then rail or offload their finished products from there. This one was started, like I said, about 2 years ago. We're already breaking ground on it. We'll have rail deliveries starting at the end of this year. We anticipate by this time next year, we'll have somewhere between 5,000 and 10,000 rail movements coming from this park, just from the contracted obligations of the existing manufacturing groups that are going to be located here. We do see other opportunities within this particular asset class and opportunity, and I'll actually be putting out information on a partnership for an expansion on this project here in the coming weeks or months going forward from there. Last project I wanted to touch base on was one that's the actual name of the development is called Esperanza. We invested in it under what we called CILB Southwest, which was Connor Investment Land Bank Southwest. This was a prototypical land bank opportunity where the developer identified the property, had already started on the entitlements and engineering, brought us in to operate as the land banker. Part of our obligations that we put on the developer was completing the engineering and then gave them time and deadlines of which they had to identify their home builders to then purchase the dirt back from us and then start development on that. So it occurred over about the course of 24 months, ended up doing very, very well. This is probably one of our poster childs if we look at how land banking successfully works. On this project, we achieved right at about a 20% internal rate of return on an unlevered basis, all of it being categorized as capital gains. So we also have nonprofit investors, and all of those were no UBTI, so they were able to get the benefits of those gains basically on a tax-free basis. And this is really where our bread and butter is, and this is where we're seeing continued opportunities in the Houston area as well as the other metro areas in Texas, and we're now in conversations with a couple of opportunities, one in Oklahoma and one that's on the further, call it southeast side of the United States, where we're continuing to expand existing relationships into states where we see continued job growth, population growth, and opportunities for investment.
But let me step in real quick. So home builders across the country, whether they're publicly traded or they're privately held, really are in the business of building homes. They don't want to be in the business of owning land, but they need that land for future lots and homes. So when they come across or they're finding nice pieces of land they'd like to buy and develop out, they come to us to work with us to help them keep that land off their balance sheet so they can take it in a just-in-time situation to develop out lots in a phase, build homes, and sell them. And that's their business. So it's very interesting how when you think about the business of development and home building, the home builders don't really want to own land. They just want to sell homes. And once you figure that out, there's an opportunity.
That's exactly right. And we see that as a continuing trend. And frankly, the financial stress that we see within some of the banking system actually creates more opportunities for us. So that as debt for, whether it's acquisition that's available to some of these home builders, as that gets harder for them to get, whether it's regional banking or private debt, as that gets harder, that actually creates more opportunities for us, because then we become more critical part of the development process for them, to help them secure the land to be able to have a future pipeline of development. And so we've seen direct impact where we get more inquiries directly from home builders and developers early in the process to try to put together the investments and be able to work with them on land banking projects for them. So we see it as a continued growth opportunity for the next 5 to 10 years, frankly, based off of what we're seeing from long-term growth trends, long-term population trends. Real quickly, wanted to dive into some of the market stuff that we pay attention to. We try to be very informed on both the sales activity, rental activity, understand what's happening in the marketplace to get a better understanding of how that may or may not impact investment decisions that we're looking at. And so we'll dive into some of these quickly. I probably have more slides than we have time, so I'll quickly bounce through them. But if there are questions or comments or what have you, please jump up, interrupt, let me know, and I'm happy to answer questions as we go through it. One of the big metrics we watch is existing home sales within the Texas markets. We're seeing that, from just an old school economics supply and demand standpoint, all of the 4 major metropolitan areas within the state of Texas, that would be Houston, Dallas, Fort Worth, San Antonio, and Austin, all of them continue to have a very tight supply of homes. San Antonio and Austin have loosened up a little bit, but Houston and Dallas continue to be extremely tight on the amount of actual homes that are for sale in the marketplace. You couple that with continued growth trends that we're seeing. We continue to grow both by population and by job. Last jobs report we got for the city of Houston, we hit an all-time high for employment, number of jobs within the metropolitan area. So we continue to see job growth, population growth, but there's simply not enough home supply to satisfy the living quarters that are needed as people continue to move to these areas. The other kind of metric that we see or dynamic is in the financing side of it. It's getting more difficult for home builders and third-party developers to get the necessary development, the acquisition and development lending to do large-scale projects. And that frankly helps us because we can land bank it and work with the developer to sell to them smaller phases so that they can make it more bite size to accommodate what we're seeing in the financing market today. From an overall perspective, when we look at median home prices, which affordability is one of the key things we look at, we've seen the majority of Texas markets, and this is consistent nationwide, peak out and frankly start to cool down, which we view as a positive thing because the rate of increase for the home prices was frankly getting too high to where affordability was becoming more of an issue. If you'll notice, Austin, we've probably had the fastest run up in pricing, is seeing the most amount of decrease on it. San Antonio is starting to feel a more of a decrease side of it. That metropolitan area, even though it's one of the 10 largest in the U.S., traditionally has a lower median income, and so they are more price sensitive on the home pricing side of it. Houston and DFW, Dallas-Fort Worth, we've seen slight decreases, but it's basically been a plateau on the pricing side of it. For existing home sales. One of the key metrics we look at, it's equivalent of like looking at a PE ratio or price to equity earnings ratio within stocks. We look at months supply. In other words, how much supply of lots or of homes are there within different segments. Traditionally, when we look at what's a month supply, we want to see about 6 months worth of inventory at the current home sales rate. We want to see about 6 months worth in that. If we have about 6 months, what that means is you'll see kind of an equilibrium in pricing, where you'll have a steady increase in pricing, but it's not an overinflated rate of increase. So currently, Houston, we're sitting at about a 3.6 months of supply of existing homes, which is still far below an equilibrium side of it. You can see that it's increased over the last year to 18 months, and that is as a direct result of increased interest rates and limited supply when things turned, call it mid-2022. We've seen that loosened up. We view that as a positive thing because that takes some of the pricing pressure out of the existing home market, which frankly is good for an overall absorption and purchasing environment within the home industry. Similarly, Texas as a whole, if we take all the metropolitan areas, we're still at only about 3.4 months worth of supply, which is still below what we would consider an equilibrium or target of 6 months worth of supply. And we see is continuing to increase in the inventory side of it. We're anticipating that it'll peak out somewhere between 4 and 5 months of supply, as the demand side of it, or population growth, simply exceeds the amount of existing homes that are coming on the market in the general marketplace. One of the, I'll consider unintended benefits or consequences, because there's been such a limit in existing homes, and this is a phenomenon not only in Texas, but we're seeing in other states as well, because there's been a limit of existing homes that have been listed for sale, in large part because people locked in extremely low mortgages 2 to 4 years ago. Those homes aren't coming on the market, and so it limits the amount of existing homes that can be sold in the market, and this has directly benefited new home sales. So as a typical ratio, new home sales would typically be about 10% of overall home sales. In some markets, we're seeing them as high as 30% of the overall market as far as new home sales to total home sales in an existing market. So it has been a direct benefit to new home sales, and frankly, you can get new home sales for better pricing and typically with more attractive mortgage options than you'll see in the existing home market. And so it's been a tailwind for new home sales in large. For the Houston area, we have seen the normal increase. And if you'll notice, in about mid part of 2023 was what we consider the bottom of the volume drop. And since then, that rate of decrease has actually been chipping away. We anticipate we'll be back at 38 to 40,000 within the next 12 months, and that's 38 to 40,000 new single-family home sales. So we went through the pricing adjustment in 2013 from increased interest rates. Home builders responded by doing incentive packages on mortgages and building actually smaller footprint homes. So they'll do that as a reaction to the market so that they are in more affordable home price. With that, and frankly, some of the stress in the real estate or in the financing market, that reduced the overall sales activity down to about 36, 37,000, but we're seeing a rebound actually closer to 38 to 40,000, and we will continue to see increases from there going forward based off of job and population growth that we see in the Texas and Houston areas. I'll bounce through some of these, which are kind of high-level touches, things that we touch base on. One of the big reasons we like operating within Texas, we have 3 of the top 7 home selling metropolitan areas between Houston, Dallas, and Austin. San Antonio typically bounces between number 10 and number 15, but we have very robust and continually growing markets where we like to operate. And so for that reason, we see a long tailwind of opportunities that continue in Texas and frankly in the other Gulf Coast states where we see continued growth on that. Demand side of it, as I mentioned earlier, we hit Houston all-time high on job growth or total employment. And so we're at a position where we continue to see growth opportunities, and we'll continue to see more. Part of us being in the manufacturing side and industrial side, we see firsthand when we know companies are relocating to greater Houston area. So we actually know of jobs that are in the queue that are not yet published and reported, simply because we know the companies that are going to be coming to the greater Houston area. population growth, again, Texas and Southeast, we continue to see growth. Texas, Florida, and the Carolinas being the biggest beneficiary of continued migration and growth moves, or growth tendencies. Texas as a whole, over a 12-month period, grew by about 500,000 people on there. And so for everybody that comes to town, it's a situation of they either need housing or apartments, and there's only a limited supply of that. So we see a continued growth on the demand side of it. I'll bounce through some of the more detailed stuff. And again, my name is Paul Connor. Philip Guyton is the operating director there, and then Dustin Moody, formerly a research specialist with John Burns and with Zonda, recently joined our team and helps us on our underwriting, finances, and market analysis as we continue to look to new opportunities in the greater Houston market and frankly beyond there. So that's what I've got for today. I appreciate the opportunity to kind of run through some of that quickly with you guys, but wanted to open it up to any specific questions, either on the market side of it or on investment kind of philosophy and opportunities.
Yeah, and thanks for doing that. That was a really good overview. There's actually a couple of questions we have, and Ken
Hi.
is working behind the scenes. One of the things I wanted to touch upon was, and you nailed it with that population growth that drives demand for residential real estate, and in turn the land that it gets built on. But also, it does increase the need for warehouses, for retail space, for medical offices, all of those things. And what I like so much about your approach to land is, again, it's not a speculative high risk proposition. It's rooted in good data. Like, I get your quarterly newsletters, and I'm always I don't want to say surprised that I'm shocked that you're putting out such well-researched stuff, but it's refreshing, I think, is the word. And I noticed that a lot of the partners, John Burns, you talked about, but some of your engineering and other partners, both technically or economically, you've used for years, and it seems like you have a great deal of confidence and trust in these people, which is great. One of the things I'd like you guys to maybe just highlight for our investors is really interest rates and the cost of capital, because with buildings, with a lot of the residential buildings that we have, obviously, the loan to value ratio is a term that many of our investors understand. You mentioned earlier, I believe River Ranch was an all equity deal. Talk to us a little bit about that and the financing costs, because it's important, but I think our investors will want to hear it from yourselves.
Sure. I'll attack that probably on a 2 or 3-fold level. So at the very end of the food chain on it is the mortgage rates, and frankly, mortgage rates are something we pay attention to, both 15-year fixed and 30-year fixed. And it's not as much of a function of what the absolute rate is. What we pay attention to is the rate of change within those rates. So, in other words, if rates are consistently at 6.5% or 7%, and they've plateaued, for a lack of a better description, we see opportunities actually tick up. You'll see mortgage applications go up. You'll see home purchases go up. It's when you see changes in interest rates that it affects the kind of the buyer's sentiment, the consumer sentiment on it. And so when you see it go from 5% to 6% to 7%, it wasn't the fact that the numbers changed on the affordability side of it. It's as much of a mental issue of people they don't want to lock into new mortgages in a rising interest rate environment. But once it plateaus, you'll see mortgage applications pick back up. And so we've been in a situation all since probably fourth quarter 2023, where mortgage rates as a whole peaked, and they've either plateaued or we've seen them slightly come down. There is a correlation between what we look at the 30-year mortgage and the 10-year treasury. So as we see the 10-year treasury continue to tick down because of reduced inflationary issues, we see the 30-year mortgage continuing to tick down as well. So that provides us with a good forward-looking sentiment that we will continue to see growth, both by stable interest rates and frankly falling interest rates. So we foresee that we will be in a growing market and that affordability will become, that the houses will become more affordable, frankly, because you're seeing mortgage rates starting to come down on a national and on a regional level. So that's at the end of it. From a financing side of it, and one of the things I touched on was the development loans or the development financing for acquisition and development. So on River Ranch, we have a large private lender based out of Boston, New York area. But we've worked with them for the better part of 10 years on different opportunities. They are our lender on that project, and they'll do in excess of $100 million within a revolving loan on that project. We're the equity that's behind that loan on that. And so one of the ways that we mentioned earlier that we help mitigate the risk profile is we pre-contract those lots for sale so that when we start development, we know what we need to develop out, and we already have those lots, those vacant developed lots, pre-contracted to sell to home builders. And as soon as they sell, that immediately starts to pay down the development loan on it. So it's a way for us to mitigate risk involved with having leverage on development deals and development projects on that. The market as a whole, it is more expensive to develop than where it was, say, 36 months ago. 3 years ago, you might could get a private lender to do these large scale infrastructure loans to do the roads and utilities and all the infrastructure that goes along with it. Those would typically be 11, 12% cost of capital to a developer. Today, it's closer to 15.
Oh,
I think you were just sort of finishing off the tail end of the financing discussion, which I think is really important because many of our investors here at McNichol might not know the exact nuances. Most Canadians are familiar with residential mortgage, but our system here in Canada is a little bit different.
okay.
So you want to comment back more on the consumer mortgage side of it, or on the call it the acquisition and development lending aspect on it?
More on acquisition and development because I think if I was before we lost the internet signal there, I think you were talking about how it's essentially the supply of capital to groups like yours that actually lowers capital costs.
Absolutely. No, one of the I guess challenges in the development side of it, and really that changed since Dodd-Frank 2008, post 2008 legislation, it's become much more difficult for traditional banks, the Bank of America, JB Morgan Chase, or large scale traditional lenders. It's hard for them to operate in this asset class because of the amount of holdbacks and reserves they are now required to have on their books, and so it's largely eliminated that as a source of debt that can go to doing development. So then it comes down to the regional bank side of it, and we still see regional banks operating within this segment, but one, they only can lend so much just simply because of capacity, and then two, they're further, I'll say, hamstrung currently because of challenges they're having with other commercial real estate, yield and cap rate oriented real estate. So apartments, offices, other projects where they've been debt, that they're having issues with it, simply just limits the amount of total capital they have that they can lend on it. And so what we've seen backfill for that is large scale private debt, which is basically unregulated, non-FDIC controlled debt. And so it's a good and a bad thing. It is more expensive, but you can usually get more favorable terms as far as the duration and the amount that you need to borrow in order to be able to develop at a much faster and larger scale, which we find helps actually protect us from inflation risks and interest rate risks. Because if we can move faster, develop more of it, and deliver it quicker, it narrows or shortens the time frame for us to go through a development opportunity. And I mean, we jokingly look at it like it's a hot potato. The moment you start, you want to get in and out as fast as you can, so that you have built those lots and you develop them to a home builder. So from that perspective, working with these large scale private debt groups, of which several are based out of Canada, has proved to be very, very effective. So even though they're more expensive on the interest rate, the structure on how we'll put them together actually allows us to move much faster and be quicker on the development time and be able to sell it and get ourselves in a very secure position, because then those lots are in the hands of home builders, and then they're building the homes to the end buyer. So it's just a matter of the development and the investments, looking at what's the most effective way to put together the structure on these opportunities.
Yeah, and I really got a flavor for that in the deals that you send our way, and thanks again for doing that. But it's just a very precision operation. You're in, you're out, boom, on to the next one, and it's that wash, rinse, repeat cycle that some of the multi-res developers had a couple of years ago, done
Absolutely.
with land, and it's really exciting. And Philip and I have discussed this in the past. Land by itself, it doesn't look that exciting, but it's more the value add that you bring to it in terms of, what you can do for your investors. So we're really excited. Ken, just from your end, are there any other questions that we could ask Paul and Philip while we've got them here? Yeah, I like to say I have yeah, yeah. I like to tell people I have an honorary MBA in commercial real estate, and Paul Connor and Philip Guyton are my two professors. So that's great. Well, gentlemen, I think if that's it, we're happy to call it an early day. We got a long weekend up here in Canada, and then you guys have the 4th of July coming up next week. So the best to both of you. Thank you for agreeing to do that, and we'll continue to look forward for more exciting land stuff coming our way up here.
Great. Thank you,
Excellent.
Joe. Appreciate it.
Thank you. Thank you, guys. Thanks.